Omotola Abimbola, macro and fixed income analyst at Chapel Hill Denham, joins us for a focus on the markets here in Nigeria and also the markets in Ghana also. Omotola, thank you for taking the time out to join us today. Let's start quickly with Ghana's inflation rate that came in at 10.01% from 10.4%. That's for the month of October. What do we need to understand about Ghana's inflation numbers?
So for Ghana's inflation print, we saw an extension of the disinflationary trend that has been observed since July. We saw that, the headline index, the headline inflation index printed lower by 30 bips year on year to 10.1%. And that was actually mostly driven by the core division, which is by 150 basis points to about 8%, which is in single digits territory. Meanwhile, we saw continued pressure in the food baskets, where we saw, the food basket, hinge higher by about 150 basis points, year on year. So I think this is not so surprising for us, as we had expected that initially after we saw a spike in inflation to a 31-month high over in July, because of the supply chain disruption, linked to the COVID-19 pandemic and the measures taken by the government, to curb the spread of the virus. We had expected that, as the restrictions, are being eased across the country, we'll begin to see, inflation rates trending lower. And that's exactly what we saw, over the month of October.
Okay, let's quickly talk about Ghana's equities index. It's down over 19% year to date. I mean, what are the factors that are driving this bearish run at the Ghana stock market?
So I think we have seen more appetite, towards relatively risk-free assets over in Ghana. Because if you look over to the debt markets, we have seen, yields in the fixed income markets actually, compress, year to date. Partly because, people have, investors are generally, very, very cautious due to two factors. Over in Q1 and also in Q2, we saw a sell-off, that was linked, to the impacts of the COVID-19 pandemic, which weighed on risk appetite, over in, both emerging and frontier markets. And then more recently as well, we're also seeing, weak risk appetite, towards the elections, that is holding, in December. So generally, over in frontier markets, typically, towards election, we typically see, investors rotate, towards safer haven assets as a result of that. But for us, for Ghana, we think that the country has displayed, a very, very strong democratic credential. We have seen, peaceful both intra and inter, government power transfer in Ghana, and political risk is to a very large extent very benign. But where there appears to be a bit of concern is on the fiscal, balance. Where we are seeing, the fiscal deficits, inch significantly higher, above 11% of GDP for 2021, compared to 4.7% of GDP in 2019. And we do not expect fiscal deficit to narrow to the previous fiscal ceiling of 5% of GDP until another 2 to 3 years. So I think that's a very, very major concern, for both debt and equity market investors in Ghana.
Okay. Okay, I'd like us to quickly cross over to Lagos here, where we saw a major surge, a big rally at the market today, to the extent that the NSE had to trigger the circuit breaker. The first time it's been used since it was introduced in 2016. The market is up at 35,000 points today. And we know that, we know the reason why this market has been rallying. We've seen low yields at the fixed income market, and that exodus back to the equities markets. But the trading today was quite exceptional. What can you tell us?
So the trading today, I would say it was mainly, against the backdrop of the NTB auction that took place yesterday, where the debt management office essentially, allotted, subscription at the auction at substantially lower yields. So the average issuance rate, yesterday was around 16 bips, 0.16%. If you look at the 1 year tenor, we saw it, allotted below 0.4% from about 0.98% at the previous auction. So the continued or the extension of the bull run in the fixed income market, mainly because of the lower prime market auction rate, it has more or less even fanned the bullish appetite that we are seeing in the equity market. So on the NSE today, we still have stocks that have very decent dividend yield. Don't forget, we are inching very close to the full year earnings results period, which will begin around February 2021 to March 2021. And as a result of that, many portfolio managers, both the local pension fund administrators to even your average retail investor, they are all trying to essentially take more risk in their portfolio to earn very, very decent returns. So on the NSE, we still have some banking stocks which have above 8% dividend yield. And if you compare that to the sub 1% interest rate we are seeing in the treasury bills market today, you would say that the rotation we are seeing towards equity in place of debt is partly justified.